What's up everybody, it's Jay Peasy. In today's video, I'm going to be talking about my trading strategy and how I find winning trades. So I've been getting some requests to make this video, and I figured it would make sense to make this video since I'm doing the small account challenge, and it would give people some more clarity as to why I choose some of the positions I choose. So I'm going to break this down into three separate parts, kind of like I did in the other video, and basically explain to you guys the trading strategy I developed and how I find high probability trades from it. So to begin, all right, here is the three components I broke it down into. You're probably thinking, what the hell is the PS60 strategy? Well, the PS60 strategy is something I learned from a guy named Dan Shapiro. Um, he has a business called accessatrader.com and a YouTube channel called Access a Trader. So I highly recommend you guys go either to the website or the YouTube channel and check out his videos explaining the process, because obviously he's the creator of this process. He can explain it much better than me. But in short, we're basically incorporating the theory of supply and demand into trading, and I'm going to show you guys how you can see in the markets how stocks or indexes will trade from supply to supply and from demand to demand, okay? I'm actually going to take you and show you what the chart setup looks like using this strategy. It consists of using an array of moving averages, using Bollinger Bands, and linear regression channels, okay? And the goal is to identify where large investors and large market participants buy and sell shares in their positions, right? So we're talking about hedge funds, pensions funds, index managers, investment banks, etc. So here's the website, right? Here's accessatrader.com. Like I said, guys, he can clearly explain the strategy much better than I can, because he is the person I learned from and the person who teaches this. So I highly recommend, if you're, after watching this, if you're interested, go check out his website and the YouTube channel. He has no idea I'm promoting his website or anything. I'm not affiliated with him in any way other than that I learned his strategy. Okay, so if you're interested, go and check that out. But I'm going to show you guys essentially what this looks like on a chart. All right, so here we go. We got a clean chart of the S&P 500 with no indicators, nothing on it, right? And I'm going to load my PS60 study set for the daily time frame. And before I do this, I want to make it clear that this works best on the daily time frame, all right? I also use this on the 1 hour, but any other time frame besides maybe the 4 hour, it just doesn't work, right? So shorter time frames, you aren't going to want to have this much on your screen, but for daily time frames, this is how it looks. All right, so from afar it probably looks pretty confusing and pretty jumbled up, but if you get in closer, we're going to explain what this is, right? So we have here, all these lines are moving average lines, okay? We start from the 5-day simple moving average and the 10-day simple moving average, okay? These are truly the two most important moving averages, and the ones that we pay the most attention to on a regular basis. Now, from the 5-day and the 10-day simple moving average, we incorporate the 20-day simple and exponential moving average, 50-day simple and exponential moving average, 100-day simple and exponential moving average, and then the 200 down here. So you guys kind of see the idea, right? 5 and 10-day, we're only using simple moving average, and then 20-day and on, we're using both the simple and the exponential. So why is that? Well, the exponential moving average accounts for volume, okay? Simple moving average doesn't. In a 5 to 10-day period, it's not as important to account for that as it is on a 20-day or a 50-day period. So that's why we use the exponential moving average from only 20 days and upwards. Now, speaking about supply and demand, we look at these lines as supply and demand levels, right? So as we can see here, our 50 days, this is our 50-day simple, 50-day exponential. These have been strong demand in the S&P for months, right? Since we crossed above here, we haven't came back down to touch this line It took all the way till the end of January, right? And look what happened. We bounced off this demand level. We also had the bottom Bollinger Band right there too. So you kind of see, how these levels play in, right? We bounced here after staying above for months, come back down, tested again the other day, bounce, and now we're coming. It looks like we're coming right back to it. I wouldn't be surprised to see this level break and to see us come down and test this 100-day set at around 368, 370. So the idea that stocks trade from demand to demand, right, can be seen here as we have a clear demand level with our 50 days, okay, holding the chart up. If this demand breaks, where's the next demand level? Okay, it's these, right? We see here, next demand level. All right, if it goes below, if it violates that low, it's got to come down and test the next demand, right? So from the other side, supply to supply, when a stock, let's say right here, we come off here, bounce, and we break above this 10-day. You see this red line right here. We break above the 10-day. Look where we go, straight to the top Bollinger Band. All right. So, as I said, he can explain it much better than I can. This is a brief overview of the strategy and how it looks, and essentially how I use price points and certain levels to make trades. But in short, we're looking to take bounces off strong rising demand levels into short stocks off of supply levels when they're overextended. That's basically the main idea. So now that you've seen that, right? You've seen the chart strategy, how I chart my how I set up my charts. The next thing I use is options flow. All right. So the scanner that I prefer is called Flow Algo. There's a couple scanners out there. They all do the same thing, but Flow Algo is where I what I recommend and where I would point people. So why do we care about options flow? So we want to look at big purchases of options and specifically out of the money contracts. All right. This morning, a great example is Boeing. There was massive call flow coming in on Boeing, and I believe there was one order that came in that was a purchase of 7,000 of the 230 calls for next week. So when you see these large out-of-the-money option purchases, it means a couple things. It means one, people with a lot of money are betting that the stock is going to go up or down depending on whether it's calls or puts, right? The second thing is that the people that sell these options, okay, actually, I'm going to save that. Before I say that, with out-of-the-money contract purchases, a stock like Boeing, right, you really need big option flow to affect it because Boeing is a big company, right? Say we have a small cap stock that's valued at $1 billion. If we see heavy out-of-the-money contract flow coming for a small cap stock, the probability that it pushes that stock in the direction of the option purchase is much higher because it's a smaller company. And the next point I'm going to get to, it will have a much bigger effect. So what I'm talking about here is the options dealer's hedge and the concept of gamma squeeze, right? So when options are sold, right? Typically when options are sold in big bunches, or these large orders we're talking about, when these options are actually sold, it's typically sold by a large institution who's already holding a lot of shares of the stock, right? So these would be covered calls, essentially. Most option sellers are holding shares to cover their obligation, right, to sell the shares. That's what happens when they're selling call contracts or put contracts, right? So the idea of a gamma squeeze, okay, is if they sell more options than they can cover, essentially, they have to buy more shares to protect themselves from, from those contracts going in the money and having to pay out those shares. So when you see, large amounts of options being sold, right, or, being bought, right, so that means they have to be sold, it typically means that these firms and institutions are going to be coming back for shares, right? They're going to be buying shares, which is going to drive the price up. And I should specify that specifically for call options, right? They're going to be buying shares when call options are being sold. It's the opposite with puts, right? It's the complete opposite with puts, right? So this is kind of a huge thing that many people miss, especially new traders. They don't really realize how much the options market affects the actual stock they're trading, especially if there's heavy speculation and heavy options buying going on. So look into flow algo. It's expensive, but look into options flow. It really can change your trading and really can help you identify things that other people are going to be, are going to miss or are going to be late to. All right. So options flow is huge. The last thing is catalysts and news events. Okay. So these could be a number of different things, right? It could be earnings reports and future guidance. Now, for myself, I don't like to hold positions through an earnings report. My favorite thing is to trade it the day after, or a couple days after the earnings report, because this is when most of the reaction comes, especially for bigger companies. A lot of banks and institutions don't have the time to do all the necessary research right at the time of the earnings call. It might take them a day or 2 days to establish their thesis, their updated thesis based on the earnings report. So a lot of times we see continuation moves, what we'll call them, when a company reports earnings and then the real move happens a day or 2 days after the report. Okay. Um, Another thing, changes in business fundamentals. Obviously, this is huge. And this could be anything from new product lines, or um, on the negative side, maybe some discontinuing a product, or building a new facility. Maybe it's political. Maybe there's new laws and regulations that the government imposes that affects a company's business. These are things that you kind of just have to always be aware of and think about. And then there's analyst upgrades and downgrades, right? So obviously there's lots of Wall Street analysts that cover thousands of different stocks, and they like to upgrade and downgrade these stocks, especially after earnings reports. So following these analyst upgrades and downgrades can also give you a good idea of which stocks are going to be in play and which stocks have, a lot of upside or a lot of downside. And these analysts, they're biased. So it doesn't mean that everything they say is going to happen or that they're right. But especially if you see a number of analysts upgrading or downgrading the same stock, typically that's a sign that a lot of people are very bullish and a lot of people want to buy the stock, right? So that would give me good indication that it's going to go higher. The thing you have to be careful with is sometimes, there's manipulation and people want to play on your emotions. So a lot of times stocks will be downgraded intentionally because banks and large investors want to buy more. So they want to see the price decline in the short term only because they believe in the business long term and want to acquire more shares for cheap, right? So you have to be careful when looking at upgrades and downgrades. I would say out of these three, I care the least about upgrades and downgrades. It's just something to keep in mind, and it's just another piece of news to use that can go into the big picture. But I hope you guys found some value from this, and I hope it wasn't too confusing with the chart setup and all of that. So I can make, maybe I'll go more into depth on charting, but I hope I explained it pretty well. So this is essentially my trading strategy and how the different things I use to find winning trades. Hope you guys enjoyed. If you're still with me, please like and subscribe. I appreciate it. That's about it. I'm out.